My name is Eric Makore. I want to help you to calculate the accounting rate of return. Firstly, the accounting rate of return measures the average annual rate of return over the asset life. It focuses on the operating income, not the net cash inflows that an asset generates. Okay, we've got two formulas. First, it says the average annual operating income minus assets over initial investment, or the second one, which says average annual net cash flows minus annual depreciation expense over initial investment. Now we need to focus on this one, which says the average annual net cash flows minus annual depreciation expense over initial investment. Here we've got a little our simple example. Let's assume that we are buying some new production equipment that cost 24,000, but it had an equal net cash inflows during its life and a 30,000 residual value at the end of its life. Now we need to calculate the accounting rate of return. Here are some of our annual cash flows. First year we've got 100,000, second year we've got 80,000, third up to the sixth year, and the total sum of our cash flows is 360,000. Now to calculate the accounting rate of return, we said we need to subtract the average annual cash flow minus average annual depreciation expense. Right, let's first find the average annual cash flows. Right, formula not in greening total inflow and it total cash inflow cash inflows the other one I say, which is 360 divided by number of years and it or life in use and it of our asset, which is 6 years. So 360 divided by 6 years, we get 60,000, which is the average cash flow. Then to calculate the annual depreciation value, we say the cost minus 30,000, which is the residual value. And if we subtract 30,000 from 240,000 divided by 6, which is the useful life of our equipment, we get 35,000, which is the depreciation expense. Now let's calculate the annual rate of return, accounting rate of return. Now the accounting rate of return, we are now saying the average cash flow minus the depreciation value or depreciation expense over the initial investment. Right, now for our cash flow, for our average cash flow, we have 60,000. Here this is our average cash flow, 60,000 minus 35,000, which is depreciation value or depreciation expense, divided by 240,000, which is our initial investment, that is the cost, 240,000. We get 42%. That is our accounting rate of return. Now the decision rule the decision rule, should we invest our capital to that asset? If the accounting rate of return exceeds the required rate of return, invest. If the accounting rate of return is less than the required rate of return, do not invest.